There's a company so vast, so quietly entrenched in our lives, that it makes entire governments look powerless. Its name, BlackRock. This single firm manages more than $12 trillion, money flowing from pensions, savings, and index funds. That's more than the GDP of almost every country on Earth. Together with Vanguard and State Street, BlackRock forms what critics call the Big Three. Between them, they effectively control around a quarter of corporate America through their voting power. Apple, Exxon, Tesla, JP Morgan, the biggest names in the economy, all share the same shadowy shareholders. But it wasn't always this way. In the mid-1980s, BlackRock's future founder Larry Fink was the golden boy of Wall Street, until a single mistake cost his firm $100 million and destroyed his career. Most careers would have ended there. But Fink turned humiliation into obsession. He swore never to be blindsided again. And what he built next would quietly grow into one of the most powerful systems in global finance. This is the story of how that obsession created a company that now quietly owns the world. BlackRock wasn't born a giant. It started as a scar. In the mid-1980s, Larry Fink was the golden boy of Wall Street, a rising star at First Boston, one of the most prestigious investment banks in America. He was young, ambitious, charismatic. For years he brought in millions. To the firm, he was untouchable. Until one trade went catastrophically wrong. So, what happened? Fink had bet on the direction of interest rates. He expected them to fall. Instead, they rose. In a single move, his desk lost $100 million. One of the biggest trading losses the firm had ever seen. And just like that, the golden boy was gone. The millions he had made for the firm were forgotten overnight. On Wall Street, you're only as good as your last trade. And this one ended his career. He was forced out. Reputation shattered. Future uncertain. It was a brutal fall from grace. The kind that buries most careers forever. But Larry Fink didn't disappear. Instead, he obsessed. Obsessed over risk. Obsessed over the question that had ruined him. How could no one see this coming? 2 years later, he came back with an answer. In 1988, he launched a small startup with just $18 million in capital. The company was called BlackRock, and at its heart was a system designed to ensure no one would ever be blindsided like he had been. He called that system Aladdin, the asset, liability, debt, and derivative investment network. At first, it was just software, a way to track portfolios, crunch numbers, model scenarios. But Aladdin was more than software. It was a map of the financial system itself. And maps have power. Because if you can see risks before anyone else, you don't just survive the storm, you profit from it. And BlackRock was about to ride that storm all the way to the top. BlackRock began small, just a handful of people. A startup with nothing but Larry Fink's obsession. Through the 1990s, it grew quietly. While other firms chased glory, BlackRock chased control. Every trade, every risk, every scenario was fed into Aladdin, and it worked. While competitors stumbled, BlackRock was steady. It didn't gamble, it calculated. Clients noticed. Soon, big investors wanted in. Insurers, pension funds, even rival banks. Everyone wanted the map. By the early 2000s, BlackRock wasn't a boutique anymore. It was a rising force. But the real leap came in 2006. That year, BlackRock merged with Merrill Lynch Investment Managers. Overnight, the company doubled in size. Tens of billions in assets poured in. It was no longer just a promising upstart. It was a heavyweight. The quiet firm from 1988 now stood among the titans of Wall Street. But bigger doesn't mean safer. Growth brought scrutiny. Rivals whispered that BlackRock wasn't just managing risk, it was hoarding influence. Competitors feared Aladdin was giving Fink an unfair edge, and regulators started to wonder, could one firm ever hold too much power? Inside BlackRock, the pressure only made Fink more determined. Every risk had to be tracked, every scenario modeled, every potential disaster controlled. But no system can see everything, and no firm is immune to the storm that was coming. Just 2 years later, the entire financial world collapsed. The year was 2008. For years, banks had been handing out risky home loans, mortgages to people who often couldn't really afford them. On paper, it didn't matter, because housing prices kept climbing. If someone couldn't pay, they could just sell the house at a profit. But then the housing bubble popped. Prices fell. Suddenly, millions of people owed more on their homes than the homes were even worth. Their monthly payments kept rising and many simply couldn't keep up. They stopped paying altogether. And when those payments stopped, the financial system started cracking. Why? Because banks had bundled these risky mortgages together, chopped them into giant packages, and sold them around the world as if they were safe investments. These packages were called mortgage-backed securities, but you don't need the name to know the effect. Once homeowners stopped paying, those investments turned toxic. Banks were failing, markets were frozen. The global economy was on the brink of destruction. Governments were desperate, but they didn't call the regulators, they didn't call the watchdogs, they called BlackRock. Because BlackRock had the one thing no one else did: Aladdin, the system that could see into the chaos, the map that could calculate the unthinkable. Suddenly, Larry Fink's obsession wasn't just a risk tool, it was a lifeline for the entire financial system. The US Treasury handed BlackRock mountains of those bad loans and broken investments, the stuff nobody else wanted to touch, and told them, figure it out. BlackRock's job was to sift through the rubble, put a price tag on the mess, and tell governments and banks who was about to sink. Central banks leaned on them to make sense of balance sheets. Even rival firms, once competitors, now needed BlackRock to survive. In the middle of the worst collapse since the Great Depression, BlackRock became the firefighter of finance. And while others were burning, it was quietly growing stronger. Because in 2009, while the ashes were still smoldering, BlackRock made the deal of the decade. It acquired Barclays Global Investors, and with it, the crown jewel, iShares. So what are iShares? They're exchange-traded funds, or ETFs. Think of them like baskets of stocks, hundreds of companies bundled together into a single product. Instead of betting on one company, you could buy a slice of the entire market. Safer, cheaper, easier, ETFs were exploding in popularity. And overnight, BlackRock became the biggest player in this booming market. From a fragile startup in 1988 to the world's largest asset manager in just 21 years. But its true power wasn't measured in dollars. It was measured in dependence. Because once governments, pensions, and corporations plugged into Aladdin, they didn't leave. They couldn't leave. BlackRock wasn't just another Wall Street firm anymore. It was infrastructure, a machine embedded so deeply into the system that pulling it out could collapse everything around it. The crisis had destroyed trust in Wall Street, but it had elevated BlackRock into something more dangerous. Not just a company, but a keystone of global finance. And yet, this was only the beginning. Because as BlackRock's power grew, so did the questions. If one company controls everything, then who can stop them? By the 2010s, BlackRock had become one of the most powerful financial institutions on the planet. It manages trillions of dollars in assets, more than the GDP of most nations. But it isn't just the money, it's where that money sits. BlackRock holds stakes in Apple, Amazon, Microsoft, Exxon, Tesla, JP Morgan, Pfizer, the biggest companies in the world. And it isn't alone. Together with Vanguard and State Street, BlackRock forms what critics call the Big Three. Between them, these firms control a quarter of all corporate America, not as outsiders, as the largest shareholders. Which means when big decisions are made, from boardroom votes to CEO pay packages, BlackRock has a seat at the table, sometimes the deciding seat. But their influence doesn't stop with corporations. Governments lean on BlackRock too. Central banks use Aladdin to stress test economies. Insurers and pensions rely on it to model the future. Aladdin is the invisible operating system of global finance, running trillions of what-if simulations every day. What if oil prices crash? What if interest rates spike? What if a war breaks out? The answers shape not just portfolios, but policies. Because when Aladdin points one way, money moves that way. And when money moves, governments and corporations follow. But if Aladdin is just a piece of software, why can't someone else build their own? In theory, they could. In practice, it's impossible, because Aladdin isn't just code. It's decades of data. It's billions of simulations. It's trust, built crisis after crisis. Governments and corporations are already wired into it. Switching isn't just inconvenient, it's unthinkable. BlackRock doesn't just have the best map, it has the only map anyone is willing to follow. To supporters, this is efficiency, a global GPS for money. To critics, it's something darker. A single company, unelected, with the power to nudge entire economies. And the deeper BlackRock embeds itself, the harder it becomes to tell where the markets end and BlackRock begins. For the average person, BlackRock is invisible. You don't see its name on your paycheck, but if you have a retirement fund, a pension, or even a simple index fund, chances are you're already part of BlackRock's empire. By now, BlackRock isn't just managing money, it's managing the system itself. And the bigger it grows, the louder the backlash becomes. Because if one company holds this much power, whose interests are they really serving?
We demand BlackRock cease investing in companies destroying the Amazon and other crucial ecosystems.
For years, BlackRock grew quietly in the background. But the bigger it got, the harder it became to stay invisible. And soon, the backlash began. Critics accused the firm of being too powerful, an unelected empire that could sway markets and governments without a single vote cast. Politicians on the left attacked BlackRock for investing in oil and coal, accusing it of greenwashing while publicly preaching climate action. Politicians on the right accused it of being too woke, pushing companies towards social policies it had no business enforcing. BlackRock found itself in the crossfire, too big to avoid criticism, too central to be ignored. Then came the lawsuits. States threatened to pull pension money from its funds. Activists demanded investigations. Competitors whispered that Aladdin was less of a tool and more of a monopoly. And beneath it all was a deeper, more dangerous question. If one company holds this much influence, whose side is it really on? Larry Fink insists BlackRock is neutral, just a steward of other people's money. He argues the firm doesn't make the rules, it just follows where the market goes. But markets follow BlackRock, governments follow BlackRock, even rivals follow BlackRock. That's the paradox. BlackRock claims it's a passive player, yet its very size makes it impossible to be passive. And so today, the debate rages. Is BlackRock the firefighter of finance, keeping the system safe from collapse? Or is it the hidden empire, reshaping the world in ways no one voted for? Because here's the truth. BlackRock is now so deeply wired into the global economy that removing it isn't an option. If it disappeared tomorrow, pensions would collapse. Governments would lose their map. Markets would lose their compass. And that dependency is its greatest power. To some, that's stability. To others, it's fragility. A single point of failure in a system too complex to control. And the question isn't whether BlackRock will make a mistake. It's what happens to all of us, if it ever does.